This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. I have with me this morning John Rubino, well-known publisher of the website DollarCollapse.com. Good morning, John. Welcome back.
Morning, Gord. Good to see you again.
John, I was just noticing this morning, this is our 37th show that we've done.
Wow, we're old, aren't we? We've been at this for a long time.
We've been doing it for a few years now. How quickly they go. And I do need to mention to our listeners, because I've been doing so many shows with financial repression, this is not an interview. This is a discussion that John and I have once a month, and we record it, and we move on various subjects. Right now, we've been focusing on some of John's writings that are going out because they've been a good springboard. So it's a dialogue, and it's not an interview. So when I interrupt you, John, people know why I'm doing it. Okay. So let's just begin. John, you this month, one of your articles that I really like was short but right to the point. It was called "We're Very Disappointed in You," and I wonder if you could share with our listeners what the key message was there.
Sure. The general consensus, at least among the talking heads of the world right now, is that the U.S. economy is in a recovery, that things are getting better, and we're growing, and we're definitely not in recession anymore, and that good times are coming. But if you look at the vast majority of the economic statistics that have come out in the last 6 or so months, they're all negative. We've got a slowdown in manufacturing, which is very big because that's the wealth producing side of the economy, and we've got housing starting to flatline. Home sales and new home building are both below year ago levels, which implies a contraction in that segment of the economy. And the only thing that's really up is employment, and that seems to be the thing that everybody's paying attention to. And they're assuming that if unemployment goes down, that everything else follows. But that's not the way it's working, because the rest of the economy is slowing down while employment seems to be going up. And the reason for that is that our employment statistics, as the government produces them, they're really flawed, because basically the government counts a new job at McDonald's 20 hours a week for $8 an hour as the same thing as a new engineer being hired for $250,000 a year. They count those things as the same. And the vast majority of the new jobs that are coming on are actually the former, these crappy part-time jobs that nobody really considers employment. It's something you take to put food on the table until you get your real job in your chosen career path. And the real jobs don't seem to be out there. Meanwhile, oil is way down, which is causing a contraction in the oil patch, which is reversing out a lot of the job gains that we saw in the last couple of years in fracking and oil sands production. And because of that, the employment picture really isn't good. So you can add that to the negative category if you want to, no matter what unemployment is doing right now.
John, the numbers, as you say, have been so consistently bad across the board, long lists of them, that there's nothing to talk about. And I'm talking globally, but the only two positives seem to be the labor numbers are positive and the stock market is up. Yeah. And we've talked about both, but that labor numbers, I smiled when you brought it up, because we all know the participation rate and how it's been plummeting and how many jobs, and what they're making. I mean, most of the jobs are bartenders and waiters if you look at the growth, but they're under $30,000 a year kind of salary. That's where the growth is. But, the point I'd like to make is I saw a couple statistics that showed how blatantly wrong the numbers are. First of all, we have this birth-death model, right, that comes out, and it's a giant plug number that says these are the number of new businesses that are starting, but we don't know how many jobs are creating, so we put a fudge number in there, the Bureau of Statistics. And then they adjust it every year by 400,000 or 500,000 once a year down the year following. And it doesn't never match. But I saw Gallup came out the other day, Gallup poll, and showed that we have had a net loss of 70,000 businesses over the last year and where we're at right now. So the net loss of businesses is falling dramatically. Yet labor numbers are going up for the birth-death model. It completely disconnects. So I'm laughing at that. Then this week, we've got the construction numbers coming out. And so in a new business, the non-farm payrolls, we saw all of the job growth. A lot of it was in construction and building. So obviously new homes or whatever, residential. So that comes out. Then comes out the new housing starts and permit numbers, and they're in free fall. So it's going down. It's going up. Somebody who looked at this and said it makes no sense. It must be in renovations, kitchens, upgrades, that sort of thing. They went and looked at Home Depot and Lowe's, and it isn't there. So I mean, it's just blatant, these plug numbers that are going in. So if you take out those labor numbers and the points we've just made, the only things left is the stock market is going up. But if the stock market was down 1,500 points or so, or 1,500 on the Dow, we'd have a whole different sentiment, wouldn't we?
Yeah,
and that's the gig. And remember, we
really
know that it's buybacks. 90% of last quarter's profits all went back into dividends and buybacks. So come on.
Well, this takes us into a really interesting area here, which is that government policy around the world is turning everybody into a hedge fund right now, because we've borrowed too much money and we need to somehow continue to grow, even though we already owe too much money. They've forced interest rates down to zero and to negative levels in a lot of cases. And this leads everybody, whether you're a pension fund or an insurance company or a retiree, if you need income, you have to reach for it by going further and further out on the yield spectrum. And so that's pushing you into equities. You know, the Japanese pension funds just announced in the last month that they're continuing to increase the amount of equities that they're buying. They're selling bonds and buying equities. Everybody else in the world is doing that too. And that's pushing up the stock market around the world, but at the risk of these formerly risk-averse entities becoming hedge funds, where they take massive risks in return for the hope of high income in good times, but at the risk of 30% loss when things go down.
That's is the risk.
Yes, The risk-adjusted returns are not what they look like. Yeah,
and it goes on until it doesn't go on. But your point on Japan is a classic. Yeah. So here the pension plans, because they just stacked the debt. The largest pension plan in the world, the government. The Japanese government is buying equities, both foreign and domestic. So they're selling their bonds, and which are supposed to be the prudent investment. Who's buying the bonds? Japanese government. So they're just the Bank of Japan rather. So they're just printing the bonds, and they can't sell them. So they're buying them back. Here they are. They're buying them back from the pension fund. So then, even then, with that amount of buying, there's been 33 different occasions when the buying said that the Nikkei was going to still fall off. The Bank of Japan stepped in and started buying stocks.
Yeah.
So, and I don't think that is unique to just Japan that's going on right now.
No. Well, in effect, we have around the world governments buying equities.
Yes.
As part of a public policy program of trying to force up returns on high-risk assets in order to keep the economy going. And that's just, that's something
John,
that has
if they don't do that, pension plans and insurance companies will implode.
Totally.
Just think what negative interest rates in Europe does to a pension plan insurance policy. Your business model just went poof.
Yeah, because you need to make 8%.
Right.
Year after year in order to be able to pay off the people you're supposed to pay off. And if the fixed income part of your portfolio is yielding negative 1%, then that means you need 12, 14% on your equities year after year just to be solvent, just to not be massively underfunded at an accelerating rate. And how do you get that? You do that but with growth stocks, basically, and exotic instruments like options and futures contracts, which is exactly the wrong place to be if you're a risk-averse entity that has to have X amount of money at a given time. because you can't control even assuming you make on average over a long period of time the kind of money you think you're going to make in options and futures contracts, you can't control when it comes in. You might be down 30% this year, up 40% next year, and so on. But if you need that money this year, you might be down 30% and not have it. So there's no real way to know whether you're meeting your obligations when you're taking on all this risk. And the odds are, after really a 6-year unprecedentedly stable bull market, the odds are that you're not going to make that kind of money going forward because you've already made it. Anybody who's been in high risk assets had a hell of a run for 6 years. And the world doesn't work that way, where you have a great run for 6 years and then you have another great run for the next 10 years. That's just not how it works. You've got to have a correction. And the correction, when it comes, is going to be a different animal this time around, because you've got all these formerly risk-averse entities highly leveraged and really exposed. So what happens when the stock market goes down by 20% this time, as it inevitably has to? Unless governments continue to buy stocks by printing new currency and shoving it out into the market, which in that case we have a currency crisis out there somewhere. Either way, financial assets have a big correction at some point in their not too distant future. And then you see money market funds blowing up and pension funds blowing up and insurance companies going bust. And these are things that didn't happen in the last correction. As bad as the 2008-2009 crisis was, most of these supposedly risk-averse entities survived. They didn't go bust. This time around, they're liable to go bust. They're liable to just vaporize. And so that's the kind of situation that we've created. How it plays out is anybody's guess, but there has to be a hiccup, and the hiccup has to have reverberations that are more extreme than usual. So that's our next few years. Somewhere out there, it's coming.
Somewhere out there. But right now, the central banks, my opinion, they can't let the equities, the asset values fall any more than, say, 12%, 8 to 12%, because of the amount of leverage, the amount of cascading, the collateral collapse and contagion that could come out of it. So they've just got to stop it. So they could keep playing games here, but the problem, John, is what we've got now is demand is falling off. The demand is not there. You're seeing it in the suppliers, the commodities falling because it's literally free fall. The Baltic rate is at a rate we haven't seen dry since the 80s, 1980s. I know there's new ships coming on board, but it's right across the board. And you'd said earlier about the recession. Things go around in cycles. We're due for another recession, just as a normal course of the cycle of this, 5-6 years. I got a chart up here that is actually sending signals that's a strong possibility of it happening. And if that happens and we start to see a real global slowdown, which we're seeing, the central banks can't stop that. They can't. The financials will have to correct. They're just not big. Now, I'm not saying it's imminent, but at some point it must happen. Either that or the financial markets no longer exist in the form that you and I are accustomed to. They're now centrally controlled and managed.
Well, yeah, that's the case today. And in the U.S. we have a really distorted picture of all of this because we feel like the average person in the U.S. feels like there's a recovery going on because stocks are up and the employment numbers are coming out very positive. But around the world, everybody else feels like they're in recession because, except for possibly Germany, because they've got deflation and they've got falling, oil prices and the employment numbers aren't coming back. And so around the world, central banks are cutting interest rates instead of raising them. We've had 23 rate cuts so far this year. And some of those rate cuts have been from zero into negative territory. So that's a picture of panicked governments around the world. You don't cut interest rates to, negative 0.75% unless you've got a very serious problem out there. And yet that's what we're seeing around the world. So here with interest rates still 2 or 3% on treasury bonds and some positive economic numbers coming out at the headline level at least, we don't feel like it's a crisis yet. But a lot of the rest of the world is acting as if they feel like it's a crisis. And the question is who's right? I think the rest of the world is definitely right, you know.
John, I happen to believe, and this may shock you, I don't believe we ever came out of the recession in the United States. If you really look at the numbers properly and you look at the GDP numbers correctly and how they should be calculated with proper deflators, proper rates of reflation, of inflation that are in here, it's not there. And okay, I may come off that a little bit because of the Fed increasing its balance sheet by $4 trillion and us pumping in $11 trillion in fiscal spending over 6 years. I mean, okay, maybe, but that artificial might have pushed it in a positive territory, but we have no growth. Top-line growth in the corporations is falling, John. Real disposable income is falling. That happens in a recession, not in a recovery.
Yeah.
It's just basic. But, you know, there's an old saying, if you tell a big enough lie long enough, everybody starts to believe it. But look around you. I don't see it.
It's important to put this in a currency war perspective, too, Gord, because we started QE before anybody else did after the 2008-2009 crisis. We cut interest rates dramatically, and we started buying back bonds. And as you said, we pumped $4 trillion into the economy via the Federal Reserve's balance sheet. And that, you know, it didn't, as you said, pull us out of recession, but it stabilized us relative to the rest of the world. So we feel relatively healthy. But that was because the dollar was relatively weak and we were, increasing the Fed's balance sheet dramatically. Well, we stopped that. The dollar's way up now. And the Fed has almost stopped increasing its balance sheet, and which means it's almost stopped pumping new currency into the market. And so you're seeing a reversal of this situation now where the euro is down by 30%, the yen is down dramatically. And in Germany, at least, exports are at record levels now because they're using a weaker currency to price their stuff. And Japan isn't growing, but it's relatively stable now. And so it's our turn to suffer by being on the losing side of the currency war. So that's a big part of the negative stats that are coming out now, is that the dollar has soared. So that hurts corporate profits, as you said, and it just generally makes life harder. That's increasing the value of your currency by 30% is the same thing by raising interest rates by a commensurate amount. It makes money more expensive and therefore makes debts harder to manage. And so that's the situation we're in right now. And so another big question for us is how much further can it go? How high can the dollar get before it pushes us into an objective recession where the numbers can't be hidden anymore, where we can't pretend that we're growing?
Exactly.
And I think we're pretty close to it. I mean, we're seeing that now. The Fed is already walking back the whole interest rate increase in June.
They have to take some of the strength out of the U.S. dollar.
Yeah.
It's because everybody else is quoting or expanding credit, and we're supposed to be flat, which we are. That in itself is just pushing the money into the United States. We've got to look like we're going to delay increasing the rates, and to try. We've got to bring down this U.S. dollar, John. Right now, if you look at China and the problem China has right now, they've got to do something with the yuan, and I'm sure they don't want to, because they're taking it in a year from the yen against that level of currency of cross, and they've got to create 10 million jobs a year, and manufacturing's slowing. Yeah. They've got to do something, and they're not going to. The people hold them responsible for jobs. So what are they going to do? Well, I think the United States, the government, Treasury, and Fed know this. So we've got to weaken this U.S. dollar somewhere. Because look at the euro. We're going to parity, and I saw Goldman Sachs saying even lower.
Yeah. And so how do you weaken the dollar in this environment when everybody thinks we're recovering, when government debt has been doubled in the last 5 years, when the stock market is at levels that traditionally precede a horrendous crash, and when interest rates are already short-term 0, long-term 2-ish? What do you have to do? You actually have to force down long-term interest rates to 0 or so. We have to go to the point where we're like Germany, where 5- and 8-year bonds now have negative yields.
Negative real or negative nominal rates could be around the corner.
Yes, yeah, they could be. So that's
we had negative real for quite some time, but negative nominal like Europe.
And that's a huge policy reversal from where we are now, where the Fed is saying, well, we're going to start raising interest rates. We're going to reverse out, the debt monetization that we've done in the last 5 years. So when that happens, that is going to be an earthquake for the financial markets. But of course, it might be a less catastrophic earthquake than raising interest rates. That would be shocking because, and then we get into the dollar carry trades around the world. If we were to do something like raise rates, which would make the dollar go up from here, then you've got that $9 trillion worth of dollar-denominated debt around the world that's already underwater, that's already losing money, and that's bigger than China's economy. That's a huge amount of debt that's out there.
John, I did some work on this carry trade and these negative interest rates, and how can people be making any money on negative interest rates, right? And what I went through the calculations in real terms. It turns out that if you use some of the old curves, if you can make 1 or 2% on currency and use the carry trade, you can actually make some money on these negative rates. So you may lose on the bond, but you're going to make it on the currency and how you borrowed against it, if you believe you know where it's going to devalue at a faster rate. Does that make sense to you? And that's
you mean going forward?
Going forward,
betting the dollar's going down.
Well, it depends on which part of the trade carry trade you're playing with, where you're borrowing to buy the bonds, the negative bonds. But that's what they're doing. So the currency wars have fostered a new way of investing rather than pure, even though you're taking on a negative side of it. It's just so convoluted. But that's the game that's starting to happen right now.
Well, yeah, the guys who are in the leverage speculating community don't have much choice but to play the game according to the rules that governments have devised. Exactly. But they're incredibly dangerous rules because volatility is going through the roof right now. And so if you're on the wrong side of pretty much any trade out there, and you're leveraged, and volatility is double or triple what it was a few years ago, you're at extreme risk. You can blow up any day now. And that's on the verge of happening with a lot of interest rate derivatives, a lot of these dollar carry trades, and a lot of energy-related junk bonds and related derivatives. There's been huge volatility in all three of these markets. And that means that for every deal that's been done in the last couple of years, somebody's on the wrong side of it, right? And so we don't know who's going to blow up, but it's pretty much guaranteed that lots of blow-ups are coming, because so many people are on the wrong sides of these trades, and so many people are highly leveraged to be on the wrong sides of these trades. And that's just now. More volatility is probably coming because we've got so many big decisions out there on the part of central banks that are looming, right? These guys have to cut interest rates or raise interest rates, and they don't know what they're going to do either, and any of these things are going to cause big moves in the markets that will affect leveraged players one way or another.
I was talking to Tim Price in London and about this situation, and I said to him, I says, at any time somebody's going to yell fire and everybody's going to be crammed at the door trying to get out. And he says, oh, Gord, that's not going to happen. And I says, oh, really? He says, no, you're looking at it wrong. You have to know that the doors are locked for the theater. You're not going to get out, and the only way to get out is you have to exchange your seat with somebody who's outside of the theater. They have to take it. And he says, and what do you think the chances are that they're going to take trade your seat? Zip. The only way to get out is you got to move now, he said. And it's because of the liquidity and the amount of leverage that's there, and the liquidity is already drying up at a phenomenal rate. And part of the reason for the drying up is the Fed and these have taken so many of the bonds out of the market that have been used for collateral that's not there. They're not printing anymore. There's a shortage of collateral. You have to post something to borrow money.
Yeah.
And so it's just not there, and it's seizing up because you still have non-performing loans that are not working. Then there's this erosion. So I think it'll force, it's my opinion, that the Federal Reserve's balance sheet will be significantly larger this time next year than it is right now.
Mm-hmm. Yeah. They have to reverse course at some point. And then
And the dollar is going to force them to do that, John, in my opinion.
Yeah. I mean, it's already doing that. They're already walking it back, and it's hard to imagine that they ever come back to, we're going to raise interest rates this month. That kind of an announcement just doesn't seem feasible anymore. And so,
but they
get back to
talk that they have to walk that talk, or get people. Otherwise, the whole investment everything changes. So it's a little bit of a sell game that's going on. How did you? Last question, John, before we run out of time. How did you translate the FOMC meeting this week? What was Yellen really saying, or what signals were there?
She didn't say anything really.
That in itself is telling.
Yeah. What they promised was basically that they'll stay on hold for a while. They'll keep current policy for a little while longer before they decide. And since the markets were expecting a negative change from the point of view of risk assets in the near term. So the stock market is up today, and oil is up, and gold and silver are way up because we got risk on once again, because people assume that there's going to be relatively easy money for the foreseeable future. And, that's really the only thing they can do. In every future FOMC meeting, they're going to have to come out with a variant of this, and at some point, they're going to realize it's not working, because remember, we've got a slowing economy. As we started this talk with, the economy in the U.S. is slowing down, heading for zero, heading for negativity. We're going to be in recession if current trends continue for another 6 months. And so under current policy, we can't grow. So two choices going forward: tighten money in the face of an incipient recession, or open the floodgates and restart the currency war on U.S. soil, cut interest rates, come back with a new QE program where they're buying, whatever bonds are left in the market with newly printed currency. And that carries with it its own risks of instability. And that's basically it for them. They don't have a happy medium where they pick a policy course that gives us steady growth in the future. They just have these two hugely risky choices. It's binary right now. Either we open the floodgates and go back to really aggressively easy monetary policy, or we tighten and take the risk of pushing us into a recession that could become a depression very easily. And that's it.
Exactly.
Yeah.
Exactly. Where is the growth in the world? Where is the bright light? It was supposed to be the U.S. And it's not.
Nah.
Where is it? It's not there.
Only Germany is happy right now, and that's because they've been able to devalue their currency by 30% and export a lot to the rest of the world. But that's coming at a price of trouble in the rest of the Eurozone, which is very possibly going to break up the Eurozone in the next couple of years. They either have to go to a totally Germany-dominated system, or they have to spin apart. Neither one of those are attractive from the point of view of a European. So yeah, that's the only place that you would call a bright spot right now, and even that's kind of a false bright spot. So you got the emerging markets tanking.
John, but the euro has plummeted from like 150 down to nearly parity.
Yeah,
we're talking about near a 50% reduction in. You would think that would pick up a little bit of demand on the export side, right?
You would think, and it's working for Germany. But the rest of the Eurozone
so there's
is
a little bit there with 50%. What, are they going to do another 50%?
Yeah. Well, I mean, they need to do...
That's a currency war, right?
They need to do a lot more in order to survive as an entity, the Eurozone. And so the question is, can the U.S. let that happen? Because we're basically taking their pain right now. And, how much pain are we willing to take for the team in terms of the global economy? And I think it's arguable that with the presidential election coming up,
that's exactly where I was going. With a presidential election, I don't think so.
Yeah. So it all depends on the stock market now. As long as equity markets keep going up, they can maintain the illusion of prosperity or of stability.
As long as the evening news shows that the Dow is flat or up, everybody says, things must be all right. And the labor numbers come out and they show they're way down, or unemployment is down. Everybody says, well, what I'm seeing around me can't be true.
Yep.
And, the other day when I was looking at the growth in those housing numbers that I mentioned earlier, not the housing numbers, the employment for workers and construction people, I was forced out of my building that I'm in. The other half of the floor that I have is a very old commercial real estate company. And I got forced out and there hasn't been anybody around there for months. And I'm going, what's going on? Because they had turned off their heat. and because to cut costs, because there is no business, there is no sales, and this is an old, established, proven entity up here in the Northeast. So I'm going. I look at the numbers that the government's giving me, and I'm sitting on the side of the street as the fire department's there because it fired off because of the heat off. It fired off the fire alarm sprinkler systems. So that's the reality. So what do we believe? Well, obviously we believe the nightly news. Employment's good and the stock market's up. That's not what I'm seeing.
No. And eventually the truth comes out. Fundamentals always win in the financial markets. And we're just using some new experimental tools to keep the illusion going longer than usual.
The sooner we get through this, John,
yeah.
Because on the others, the world is not coming to the end. We need this cleansing in our economic system where we can readjust prices, we get price discovery, we get rid of some of the malinvestment. It'll bring in new investment. And we can, and we'll begin again. That's why we need the cycle. It's a natural, healthy process. But by not allowing and playing these games, it makes it worse. It's just a matter of time. But we need to do it because, John, there's so many exciting things that are going on. It's from a technology, etc. That there's some great things. But everybody is scared about investing right now. They're concerned about it.
Well, what the really scary thing about this whole conversation and this situation is that the guys in charge don't seem to understand the system in which they're operating. They don't get capitalism, because if they did, they would understand that, like you said, you need periodic forest fires to come through and get rid of the bad decisions that were made in the past. If you keep all those bad decisions in place by shoveling easy money at bad ideas, you end up with a forest where the dead trees and the underbrush and whatever's down there on the ground is so thick, and that when a fire does come, it burns so brightly that it takes everything. You get a fire that's so hot that you wipe out the system. And that's the kind of conditions that we're creating, where the next crisis is potentially system threatening.
Yes.
And these guys don't understand that that's the conditions that they're creating. And that's what's really scary, because when people in charge don't understand the machine that they're running, and think they can apply different rules to something and get the same result, then you set the stage for something really catastrophic. And that's what we're doing right now. And so it should be terrifying.
Central planning doesn't work.
No, and central planning applied to capitalism really doesn't work, because you get all these distortions that lead to really big problems, and that's what we have when the next financial crisis. There are going to be air pockets under everything, and leverage everywhere. So it's going to make 2008, 2009 look like a hiccup. And the only question is when.
Before we break, John, I got to say to our listeners, don't underestimate the central bank and the government. Still, things that they will come up with. They will shock you, but they're not going to go down. They're going to do everything in their power. So this could go on for a while.
Yeah. I mean, one of the next things they have to do is devalue currencies across the board instead of back and forth.
Exactly. Yeah. These are the kinds of things you're going to see.
Definitely.
So, don't go out there and just start shorting the market expecting that this is going to happen, because you're going to be potentially very broke as this drags on. That doesn't mean I don't think in the short term there's some consolidation and corrections in here, John. Don't get me wrong there.
No. But someday shorting the market is going to be one of those trades, like in
a lifetime,
Mike Lewis's book.
In a lifetime.
Yeah, the Big Short. It's going to be the housing bubble times 10, where some people make tens of billions of dollars out there by timing it just right. So that's the challenge.
I would argue that is the case, but it won't be where it's going down. I believe you may have the markets locked up for a week or 2 weeks because of the severity of the crisis, and you really don't know what you're at.
Yeah.
Until it opens up again. And then people that were on short, which theoretically should have made a lot of money, there may be other mechanics that are put in so that they really don't get those payouts. There's going to be, and it could be because of currency adjustments and what they have to do to get out of the crisis, and devaluation of currencies, and therefore what you actually get paid out and what you thought you'd made. It's going to be dramatic. It's not going to be what you expect it to be. That's my opinion.
Yeah.
But on the other side of it, John, I think in our lifetime we're going to see some of the greatest years of ever with technology and everything else that I see. It's going, but we need this cleansing so we can get on with it. We're just stalling the future right now. Yeah,
that is going to be so nice to sit here and talk to you about positive stuff like, virtual reality is doing this and artificial intelligence that, and that's coming, but we got to get through the crisis.
I spent all of my career building technology, exciting, and it seems to me you spent the last 10 or 12 years in just one bad policy which makes things worse after another. And really what's happened is since we really started accelerating money printing to solve problems instead of letting the capitalist system naturally cleanse itself. Mm-hmm. So I think that that's it's an error. It's a stage, and we'll get through it, and we will learn, and the new generation will learn these lessons. John, we're way past our hard line. We've got a break. Any key messages you want to leave before we break?
No, we've covered it pretty well, I think, Gord. So we'll reconvene next month with some new stuff, I think.
Absolutely. Yeah. So I'll talk to you again next month?
Yeah, looking forward to it.
Thanks, John. Thanks for the time. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.